Hey everyone, and welcome back to the channel. If you want to build wealth that lasts, you can't just rely on stock tips or frantic day trading. You need a system. Today, we're giving you that exact system. The Warren Buffett method for stock analysis. This isn't about complicated charts or confusing algorithms. It's about analyzing a business like you're going to own it forever. This is the very framework that turned a few $1,000s into a multi-billion-dollar empire. We're going to spend the next several minutes breaking down this powerful analysis into 4 simple, actionable steps that anyone can use to find a great business at a great price. We will cover the qualitative check, the moat analysis, the quantitative check, and finally, the crucial step of valuation. My goal is to equip you with the tools to confidently look at a company's financials and decide if it's worth owning for the next 20 years. Ready? Let's dive into the blueprint. The first rule of the Buffett method is beautifully simple. Never invest in a business you don't understand. So we start with the qualitative check. This is where you get to know the story of the company. First, you need to define its business model. What exactly does this company do to make money? Is it selling a subscription service like Netflix? Is it manufacturing a physical product like Nike? Or is it charging transaction fees like Visa? Take Coca-Cola, for example. Its business model isn't just selling sugary drinks. It's leveraging a globally dominant brand name and a vast, almost untouchable distribution network to place its products within arm's reach of billions of people. You have to understand that core engine. Next, you need to look at the management team. Are the people running the show experienced? More importantly, do they have integrity? A great way to check this is to read the CEO's letters to shareholders from the past few years. Are they transparent and honest, even about their mistakes? Do they treat shareholder money like it's their own? Buffett famously loves owner-operators leaders who are deeply dedicated to the long-term health of the business, not just their next bonus. Finally, assess the industry stability. Ask yourself, is this an industry that will still exist and likely be similar in 20 years? Buffett prefers businesses that are simple and resistant to radical, unpredictable change. This is why he often found fast-moving technology too difficult to predict, which led him to businesses like railroads and insurance. If an industry is constantly being disrupted, it makes forecasting its long-term future almost impossible. You want a playing field that's stable. Once you know the business and you like its story, it's time for phase 2, the moat analysis. Buffett's favorite word in investing is moat. Just like a castle's moat kept out invaders, a strong economic moat protects a business's profits from hungry competitors. This is its sustainable competitive advantage. Think about it. If a business is making a lot of money and is easy to copy, new rivals will flood in and eat away at those profits until they're gone. There are 5 main types of economic moats you need to learn to identify. The first is intangible assets. This includes things like powerful brand recognition, think Apple or Nike, or valuable patents that protect a product, like a blockbuster drug from Pfizer. The second moat is switching costs. How difficult or painful is it for a customer to switch from this company to a competitor? Think about your bank or enterprise software like Microsoft Office. The hassle and cost of switching keeps customers locked in, even if a slightly cheaper alternative comes along. Third, we have network effects. This is a powerful one. The value of the product or service increases as more people use it. Social media platforms like Instagram are a classic example. The more of your friends are on it, the more valuable it is for you to be on it, too. Payment systems like PayPal also have strong network effects. Fourth is cost advantage. This is when a company can produce a good or service at a significantly lower cost than its competitors, allowing it to either offer lower prices or enjoy higher profit margins. Think of Costco's massive purchasing power or a highly efficient oil refiner. And the fifth moat is efficiency, sometimes called a toll bridge. This relates to owning a piece of essential infrastructure or having a dominant market share that is nearly impossible for a competitor to replicate. A major railroad controlling a key route or your local utility company are perfect examples. Your job as an analyst is to find the company's moat, confirm that it's durable and long-lasting, and check if management is actively working to make it even wider and deeper. Alright, once you've confirmed the business is good and it's protected by a strong moat, we move to phase 3, the quantitative check. This is where we say, show me the money. We're not looking at tiny day-to-day fluctuations. We're looking for a long-term track record of financial strength and consistency, ideally over a decade. You'll need to pull up the company's three main financial statements: the income statement, the balance sheet, and the cash flow statement. The first key metric to look for is return on equity, or ROE. This measures how effectively management is using shareholder money to generate profits. A high ROE shows that the company is a great capital allocator. Buffett prefers to see a consistently high ROE, ideally above 15% over the last 10 years. Next, examine the gross profit margins. This tells you how profitable the company as core product or service is before all the other operating expenses are factored in. High and stable gross margins, say 40% or more, are a strong indicator of pricing power, which is often a sign of a great moat. But perhaps the most critical metric of all is free cash flow, or FCF. This is the actual cash the business generates after paying for its day-to-day operations and investing in its future growth. This is the true source of shareholder value. Free cash flow is what pays dividends, funds stock buybacks, and pays down debt. What we want to see is a clear history of increasing free cash flow year after year. Finally, you must check the debt-to-equity ratio. Buffett absolutely despises excessive debt. He wants to see companies with conservative balance sheets where debt is low and easily manageable. This ensures the company is resilient and can withstand economic downturns without facing the risk of default or having to dilute shareholder value by issuing new stock. A strong balance sheet is a sign of a business built to last. This brings us to phase 4, valuation. This is the final and most crucial step, because as Buffett says, price is what you pay. Value is what you get. Even a wonderful business can be a terrible investment if you overpay for it. Your goal here is to estimate the company's intrinsic value and then apply a margin of safety. Buffett's preferred method is a discounted cash flow, or DCF analysis, which can get a bit complicated. But we can use some simpler proxies to get a good idea. One is the price-to-earnings ratio, or PE ratio. But don't just look at the current PE, you need context. Compare it to the company's own historical PE ratio over the last 5 or 10 years. And also compare it to the PE ratios of its direct competitors in the same industry. Buffett is looking for a reasonable PE relative to the company as quality and its future growth prospects. An even better and more direct check is the price-to-free cash flow ratio, or PUFCF. This compares the company's market price to the real cash it's generating. We're looking for a company that produces robust free cash flow relative to its stock price. Once you have your estimate of the company's intrinsic value, what you think it's truly worth, you absolutely must apply a margin of safety. This is your protection against being wrong. If you calculate that a stock's intrinsic value is $100 per share, you shouldn't buy it at $99. You should only consider buying it when it trades at a significant discount. Say it's $70 or $80. That 20 to 30% cushion is your margin of safety. It protects you against inevitable errors in your analysis and all the unexpected setbacks that can happen in the business world. Great investing is about buying quality at a discount. So there you have it. The 4-step framework: the qualitative check, the moat analysis, the quantitative check, and valuation. This is the analytical engine that drives true long-term value investing. It's not some hidden secret, it's a discipline. And it requires patience, consistency, and a willingness to do your homework. Use this method to filter out all the market noise and identify that small handful of truly great businesses that deserve a permanent spot in your portfolio. If you stick to this discipline, buying wonderful businesses with wide moats at a sufficient margin of safety, you will put yourself on the path to building true, lasting wealth, just like the Oracle of Omaha himself. If this video helped clarify your investing process, please do me a favor and hit that like button. It really helps the channel and lets me know what content you want to see next. And if you're new here, make sure to subscribe for more actionable financial analysis just like this. Now, go find some great businesses. Thanks for watching, and I'll see you in the next video.